Hi everyone, Shaun Humphries here with All Things Retirement. Welcome to our weekly review of all things retirement as it relates to the latest in the news. We're going to cover off capital markets, the latest in retirement planning, estate planning, cash flow management, and health aspects related to retirement. Unemployment rate dropped to 6.9% in Canada for October. So the jobless rate fell, the first decline in 4 months, signaling resilience in the labor market despite other headwinds, of course, the economy is dealing with, particularly with the tariff disruptions. And there's been some loss of employment, obviously, in the auto sectors, among others. So what does that mean? We saw the Bank of Canada reduce interest rates previous to this most recent jobs report in anticipation that the economy needed some subsidy, some support, some help along the way by reducing interest rates. This positive direction in employment data may put a pause on the Bank of Canada's inclination to do further rate cuts in the short term. So in terms of inflation and interest rate outlook, it's so hard to know in this very volatile macroeconomic climate. Likely we're going to see interest rates stay constant for a little bit longer until we see more economic data. What's the impact for you in retirement planning, whether you are about to retire or already retired? Likely we'll see interest rates not likely go up in the short term, and so that should influence your approach to your portfolio. Generally speaking, when you see interest rates stable or declining, that can be helpful for capital markets, both the real estate market as well as the stock market, as money seeks more attractive yields when interest rates on government guaranteed bonds and cash investments like GICs, high yield savings accounts, as those yields either stabilize or go down. For retirees relying on income and savings, now more than ever, it's important to have a broadly diversified portfolio. It's important not to get too heavily weighted to fixed income and cash securities, as that could have a really negative impact on cash flow planning over time. Those investments aren't generating sufficient yields outside of registered accounts like RRSPs, RRIFs, and tax-free savings accounts. Obviously, we're subject to taxation, which further penalizes their ability to generate sufficient after-tax incomes to really support medium to long-term retirement cash flow. So broadly diversified portfolios, as we talked about before, are focused on timeline investing, where you have sufficient short-term assets to look after the next 1, 2, 3 years of income, and then have medium-term assets trying to get a little bit more growth. And then money that's not needed going out 7, 8, 9, 10 years, that's where your growth portfolio should focus. In the arena of retirement tax, the biggest headline this past week was in the federal budget. 2025 budget proposes streamlined qualified investment rules for registered plans. So the federal government budget proposes to simplify rules related to what investments registered plans, RRSPs, RRIFs, TFSAs, etc., may hold effective January 1st, 2027, and to introduce 2 new categories of qualified investments. So why does this matter to retirees, those of you who are not retired as business owners or are retired? For those with RRSPs, RRIFs, TFSAs, the evolving rules may affect how you would hold private company shares, small business investments, or more exotic assets in those accounts. So planning now helps to avoid surprises. So what are the main takeaways from this potential change? If you hold small business or private shares inside your registered accounts, you should review them today. Sit down with your accountant, with your lawyers, or with your advisors who guided you in the initial acquisitions to see whether this legislation means that you might have to make some changes to your portfolio. So the next headline relates to estate and insurance planning. Bare trust reporting is deferred to taxation years ending on or after December 31st, 2026, giving more time for trust planning. Now, why does this matter for retirees? Many estate plans involve trusts. Example, trust for children, special needs, and succession planning. This deferral allows you to buy some time, and it signals regulatory focus so that trustees, advisors, and their executors should all be aligned to anticipate the possible changes to reporting requirements. Now, under the general category of cash flow or planning tips, good news in the headlines, a Canada Pension Plan extends gains despite macro uncertainty. A Canada Defined Benefit Pension Plan, CPP, posted 3.6% growth for Q3 in 2025. Year-to-date returns up to that point were 4.3%, thanks to resilient equity markets and easing inflation pressure. So why should this matter to retirees or those getting close to retirement? Obviously, the health of Canada Pension Plan and other large pension funds that follow similar investment policy statements is really critical. Retirees should remain cautious, but a little bit more confident about the drawdown rates given pension fund resilience. I think one of the big issues facing Canada Pension Plan and other pension plans, large pension plans in Canada, is this messaging by the federal government to encourage reinvestment of Canadian assets or assets in Canadian pension plans into Canadian projects. I have some concerns about that. I think that for Canadians, now more than any time, diversification globally is really important. If Canadian investors saving for their retirement, trying to have financial resilience, put focus to Canadian investment opportunities, particularly pension plans, I don't think that's a good policy. I think a better policy is for the federal government to make sure that the business environment is really good for new capital coming to Canada through deregulation, regulatory reform, reducing taxes at the corporate level, even the personal level, fast-tracking projects, getting legislation out of the way that keeps projects and money from flowing to this country. We shouldn't pursue policies that incentivize pension funds in Canada to overweight the Canadian marketplace. That would be a mistake for Canadians. So broad diversification continues to be critical. We shouldn't be funding these initiatives through hard-earned money by Canadian investors for their pensions by overweighting to the Canadian environment. This is not an anti-Canadian diatribe. I'm supportive of Canada, its success like anyone else. But that success is going to be driven by policy initiatives by various levels of government, not by repositioning the assets of Canadians in pension plans to stimulate investment proceeds going into Canadian projects. That's not a good idea. Now, in the news, of course, there is some information on health and energy and longevity, the general category we talk about on a regular basis. And the headline here was Canadian study, older adults can bounce back to thriving health. A study of the Canadian longitudinal study on aging found that nearly 1 in 4 adults aged 60 plus who started with suboptimal well-being regained optimal well-being within 3 years when factors like physical activity, healthy weight, good sleep, social connection improved. Why this matters? Of course, longevity is real and the quality of additional years do matter. It's not just about living longer. The evidence underscores that lifestyle investments today, exercise, sleep, and social activities can pay big dividends in health, not just now, but in the future. So when you take a look at your retirement income planning, it's not just about taxes, cash flow, estate planning, investment planning. It's also about investing in your health. And even if you've sacrificed that area, you're very busy through your career, and that got put on the back burner, it's never too late to embrace good practices around health. It makes a measurable difference. So that summarizes this week's news on all things retirement. If you're beginning to think about retirement and you want to get serious about having a planning discussion on how financial planning, retirement planning can give you clarity and peace of mind, in the show notes, you'll find a link back to our website where you can book a complimentary call and access free resources. All the best in your planning.